All right, welcome everybody. Welcome everybody. This is Axel Merk. I'm President and Chief Investment Officer of Merk Investments, and I am going to give you a live update on various things, what's happening in the markets. And today, I hope I'll do this with fewer technical glitches as last time. My goal is to give you an update on the markets, on monetary policy, on fiscal policy, on what's happening in inflation and beyond. And let me just test whether this works. I believe this is working, so that is fantastic. Here we go. Yes, indeed. Okay, so on the markets, we have had obviously a very volatile ride. And by the way, in the beginning, I showed you some disclosure. I hope that got across. I'll try to remember to do that in the end as well. On the markets, I'll talk about the equity markets, fixed income markets, currencies, gold miners. And if you have questions, I'll mention this a few times during this broadcast. Please do so at merkinvestments.com/streaming. I'll try to get to those questions later. Give me feedback how this works. My goal is to have these sessions regularly in the coming days and possibly weeks. As this crisis evolves, I think there's a good reason to communicate actively. And so bear with me as we're progressing through these markets. Markets have had major gyrations. Yesterday, the biggest percentage gain since 1933. People asked whether, well, are we through this, right? Historically, markets recover far faster, far sooner than the fundamentals do. Markets are forward-looking, but of course. And when you're in the depth of the crisis, you don't necessarily see where the light is at the end of the tunnel. And so a few caveats here. First of all, in the decline we've had, decline is rather unusual for a bear market. Usually after an extended bull market, the leaders in the bull market are the main decliners. We haven't seen that. Instead, we've seen a continuation that the leaders of the bull trend have actually held up reasonably well compared to some others. Now, clear difference is that the economy hit a wall and is being shut down. And so that's, of course, very different. Similarly, on the recovery side, usually when you reach a bottom in the market, you don't have the companies that were worst hit lead the recovery. And so when you had this 11 point or so increase in the Dow yesterday, the sort of companies that surged yesterday were in the entertainment industry, the movie theaters. They were several companies that have been particularly hard hit by this virus, and hotel industry, for example. And so you got to wonder, in the .com bust, if you take pet.com, well, pet.com was bust at the bottom of the cycle. And I would think that we're going to see several failures here before this is all over. And so it makes me wonder whether this was the bottom. I have my doubts. Let me just put it this way, and take it for what it's worth. If nothing else, and by all means, nothing what I'm going to say here is considered investment advice, and that's why I also can't go much into any specific companies. But the one thing we tend to underestimate in a downturn, we always think, oh, this is company specific, and then it spreads anyway. And so we think this is just a problem of X, Y, Z, but then there's the contagion. And now, obviously, what's also unprecedented is the policy response. I'll go into that in a bit. So clearly, that could accelerate some of that. It's my view, and I'll expand on that later, is that much of the public still does not recognize the severity of what is happening. If you have a friend, a loved one who is affected by the virus, then you'll start getting to terms with it as to the severity of this and why the sort of drastic actions are taken globally. If you take WeWork, and again, I don't want to talk about a specific company, but WeWork has a publicly traded bonds, and they have plunged. I believe they're trading in the 30s or 40s, so 30, 40 cents on the dollar. One of the main backers is said to have dropped out of the so-called rescue package, and um, many of the leases are month to month that these tenants have. And obviously, if you're out of a job, well, that's a way you can save costs. You cancel your month to month lease. And so they have difficulties to begin with. And now they're going to have many people kind of pull the rug from underneath them. Who knows how that's going to play out? And obviously the question is then, and I'm not making a kind of again a recommendation on the securities there, but the the office building is of course still going to be there. And so similarly, if you have somebody who runs a restaurant, um, the restaurant is still going to be around even if there is a default on payments. The same with a lot of other infrastructure. If you take fracking as a more abstract example, oil prices, as I talk here, West Texas is at $23 a barrel, 23.81. The the infrastructure will stick around. And so the creditors can take over and continue operating those businesses. But in the meantime, of course, you have consumers who are shell shocked, who many of them have lost their income. There are talks already how people can't get through on the unemployment websites. These sites are crashing. That's adding to the agony. And the well-offs, well, they've had a significant shock to their wealth with rather dramatic declines. And so all of that may have ripple effects far beyond. The central banks, policymakers are trying to contain the fallout with extremely aggressive action. Um, it is though very questionable to me whether we can indeed just kind of get down and bounce back up. And part of that is kind of how this virus is likely to evolve. Some people say, oh, we don't have a coordinated response. Well, of course, we could always improve the response, but no matter what the response is, it will always be uncoordinated in a global sense. Let's assume that the EU, the US, or any other bigger region got its act together. Well, there'll still be plenty of other regions that may not. And so any response on the medical side and how we deal with it has to take that into account. And so I'll talk more about that reaction here and about the virus itself here in a moment. The markets themselves, we've obviously gone through a phase of extreme volatility. When you have phases of extreme volatility, what you're getting is a deleveraging. If you use leverage in the markets, and volatility goes up, you've got to delever. Otherwise, you're going to get a margin call and you get a forced delevering. We've seen extensive forced deleveraging. And what happens when you delever is you sell the stuff you need to, and you try to, if you want to post more collateral, you try to scramble to get the safe asset. By regulation, the safest asset out there is US Treasuries. Well, the Fed has done numerous emergency actions, but the Fed cannot increase the supply of treasuries. The price has to change to kind of clear a market on that. And so even QE doesn't increase the supply of treasuries. It increases reserves. It increases flexibility in the system. And of course, these things are helping, but they're all indirect helps. And because they're indirect helps, these sort of things do take a while to play out. And sorry, I'm trying to get to close a window on another computer while I talk to you here. So these sort of things do play out, and they don't play out overnight. And so that's part of the reasons you have these gyrations. And of course, in the meantime, you have policy reactions, and you might give money to kind of the sort of companies that can weather the storm better and whatnot. But that's part of the reason you have these major dislocations. And it's not just the equity markets. We monitor numerous other markets. We monitor the fixed income markets. We monitor the currency markets, the gold market as well. And there are different, unique types of dislocations in each one of them. Also, when the Federal Reserve, for example, comes in with some of these measures, they're very blunt instruments. And the Federal Reserve and other central banks, they are not in the business of micromanagement. They don't have the infrastructure for that. And so they announce these big bazookas, and then they have to get operationally ready for them, and they have to fine-tune them. So, for example, even Bernanke did not reduce the discount rate all the way to the federal funds rate, they kept it a little bit higher. Um, and now the Fed has decided to move it down. Now, for practical purposes, the Fed funds rate is still below because the Fed funds rate is a range rather than an absolute number. But the reason why Bernanke didn't take it all the way down is because the Fed at the time just did not have the capacity to actually deal with every small bank. And so with many of these facilities, there is a markup. If you want to have access to the Fed, you can do it, but there's a penalty. And so similarly, the swap lines with different central banks, they are absolutely needed lifeblood for the global financial markets because there is dollar funding happening outside of the US where dollars are not available, and so these swap lines are necessary. But the Fed, they don't give it for free. They are risk-free operations, so to speak, because of the collateral given by other central banks and so forth. There's political dimension to it. But as far as cost is concerned, there's a margin. And so obviously, if you want to access these sort of markets, there is going to be a premium that you have to pay. And so that's one of the reasons why it takes a while for these operations to be fine-tuned, to be deployed, and so forth. So I touched on the equity market. We do have research reports, by the way, just published one on the equity markets at merkinvestments.com/research, where I go more into depth into some of those aspects. Fixed income, noteworthy is that by all means, treasuries have rallied, but not as dramatically as you might think. We're not talking about negative rates on the 10-year at this stage. As I talked here, the 10 years at 79 basis points, and it's been hovering around there. And so that's quite noteworthy. It just also is a reflection of the gyrations we've had in these markets. The Federal Reserve, one of the facilities it is opening is, I believe they call it the Main Street Lending Facility. In many ways, of course, that's a marketing thing. The Fed at this stage is not lending to Main Street, but what it wants to lend to is to businesses that have a credit rating that's investment grade. Now I heard Kevin Walsh yesterday to criticize that because why are we still dependent on credit ratings? Shouldn't we use some other method of applying that? But more importantly, of course, most of Main Street does not have a credit rating. A small business is too small to have a credit rating, and so. By the way, if you want to increase the supply of safe assets, the way to do that is for the Fed to guarantee a broader range of assets other than treasuries. So there is another step up the Fed can do. I'm not suggesting that necessarily should, but there is another step up you can do. The so-called bazooka is not depleted yet at the Fed or other central banks, and then by all means we have seen an extreme willingness to go all out in supporting markets. A brief comment here on the currency markets. Last week in particular, we saw dislocations in the currency markets that in our assessment are historically unprecedented. You've seen over 10% moves in major currencies in a less than 15-minute span. Those sort of things are enormous squeezes, potentially the blowing up of some parties, the scrambling to have players to do things, and these stress moments you see in the volatility. When you have, and I'll talk about the gold market in a second, the spreads are wider. Those are not liquidations. Those are other structural issues when you have wide spreads in certain markets. But these major gyrations we've had, many of these markets have become more orderly. And the solution here is usually not to close the markets, it's to provide liquidity for proper function of markets. And the one thing to keep in mind, as painful as some of these moves are, is they are meant for the integrity of the system. You need to allow markets to clear, even if prices sometimes are extreme. Shutting the door when there's a fire is not the solution. And so the Fed can ease that and other central banks by kind of foaming the markets, but you need to allow markets to readjust. And a group that has been particularly hard hit are the professional investors, some hedge funds, because you have these 5 sigma events, meaning you have things that you simply could not or did not model, you thought were impossible. Now we've all gotten smarter, but this has been very, very painful for many, many investors. Comment on the gold market. So uh, when you need to liquidate something, you liquidate what's liquid, and gold tends to be historically liquidated before treasuries. And so in the early phases of a crisis, gold often gets whacked. No exception here. Also heading into this, speculative positions in the gold market were very high, and that suggests that leveraged players were buying gold. And this is in the context of this is in the years of the bear market in gold, gold wasn't doing much. And when things don't do much, many of the speculators, especially the folks who trade the futures markets, they don't have an interest. They want to make money when things move up and down. And things have been moving up and down. And so they got into the game and they took big positions. And guess what? They were forced to delever. And so part of that was they had to reduce their gold holdings. And so much of that is flushed out. Um, Nobody knows whether everything has been flushed out. Just to jump around here a little bit, um, one of the things we look at every week is the sentiment amongst retail investors. And while that's bearish, it is not at the extremes. And so there are still people who don't take this stuff as seriously as I think you would if you actually um, looked around and saw what will and may happen in the real economy. Um, and so that's one aspect in the gold market. And well, let me talk about gold miners here briefly. And again, I cannot talk about specific companies. Um, the junior gold miners in particular tend to get hit particularly hard in a liquidity crunch. And the reason is that there's a concern that access to the funding markets get closed. And many mining companies, especially the smaller ones, have a notorious need for capital. You finance the next phase of growth, and then if financing is not available, they run against the wall. Now, if you are in a situation where you need access to capital soon, well, that is a real problem. The many of the junior mining companies that we follow, they are well financed for the next 12 plus months, and one of the advantages the junior companies have is they're often not producing gold. And that's an advantage is because what they're doing is they're drilling. They're drilling holes to look for gold. And if they need to shut down, well, they take a pause and they save money, meaning the fixed costs are very, very low. They can ramp things down without bleeding too much cash. Now, obviously, a lot of South Africa, for example, shut down the country and the mines are closed. And then there are specific policies, of course, in different countries. So, of course, there are some issues, but they are not necessarily as severe as you would think looking at some of the share price. Again, this is not an investment recommendation. At least these companies are, of course, extremely speculative, even under normal circumstances. Let's talk briefly here about the spread in the gold market. As I look here on my screen, the spot gold is at 16.15, and the April futures is at 16.37. And so the April gold futures is a contract where the first notice day is on March 31st, and that's just in a few days. So what's happening there? Why is there such a spread? One of the challenges in this market is it's a physical market, at least the underlying spot markets. And even the futures market, it's a contract to buy gold. And you have two significant disruptions. The first one is the refineries. Many of the refineries, notably the big Swiss refineries, they're shut down. And so you have the gold mining companies continue to supply the gold, but it needs to be refined before it's eligible for the LBMA standard or the COMEX standard, and that there is a disruption there. The other one is, of course, transportation in general of anything, including gold bars, flying them around the world. That is disrupted. And then finally, COMEX has a unique situation in that I just mentioned COMEX versus LBMA standard. The COMEX standards are 100-ounce bars, I believe 99% purity. The LBMA standard are these clunky James Bond type of bars, minimum purity of 95%. And so that that means that nobody has use for these 100-ounce bars. And so there's a very low supply of those available during good times. And so that creates disruptions, and it makes trading more expensive for everybody. You also see it in the spot gold prices that the spreads are wider. Yeah, let me, before I go into other policies, let me talk about the ETF market. And part of the reason I focus on gold is because that's just there's a lot of volatility here, but a lot of these things, of course, apply to other markets as well in other ways. Um, Gold ETFs, other ETFs, spreads have widened, and sometimes at the close, discounts, premiums have been significant. Several people have commented on that. Um, Let me give you my 2 cents on that. The Then there's of course, yep. Let me talk about one more thing here. The um, In the ETF market, you have market makers make a market, and what that means is that the market makers have a hedge book where they try to, well, where they take off on the other side of anyone's trade, and the easier it is for product to hedge, the closer the spread is in the market. And so historically, spreads, if you are in some frontier market, are very wide. Creation and redemptions might only happen once a week. Um, but there's a market maker who can make a market, but the spreads are a mile wide. Whereas something like gold, well, you hedge yourself in the futures market if you're a market maker, and the piece of cake, that's spread is one of many of these products is 1 cent. Well, that's the theory. Now, obviously, one is the specific issues in any one market. I mentioned the spreads widening in gold, for example, or that can contribute to wider spreads. The other one is when you have volumes that are extreme, these market makers, they're businesses like any other business, and so they run up their hedge book, and at some point they reach a capacity of what they can do. Each day they to can go to the issuer and deliver a basket of securities or whichever way, in physical gold in a gold ETF or whichever way it may be, or cash, and then get the shares in return. But it can happen in these extreme markets that they run out of capacity, so to speak, before the day ends. And so in order to save the system and themselves, they at some point say, well, have a good day, I can't make a market anymore. And with many of these ETFs, they're very dependent on the lead market maker. And people always say there are gazillions of market makers out there. In our experience, it's the lead market maker. If the lead market maker is at capacity, then spreads tend to widen. And so that's one reason. The other reason is, and that's been more broadly communicated, is that a lot of idiots, and pardon my language for that, but I don't know of any more technical term, uh, put in market on close orders, overwhelming the system with an order on the close. And that is by design with levered ETFs. Levered ETFs need to rebalance at the end of each day. Others have written about that much more than I can explain here. But in any case, you have on the one hand, you have the market makers capacity constraint, and then you have these levered ETFs in extreme markets making extreme decisions on close. And guess what? Well, market price is not going to reflect the fundamentals. The system works because you can place a trade, but you're not going to get the price that you had in mind. And that's why I refer as a market on close orders idiotic. It's just a blind thing out there. I must get executed at any cost. Well, you're going to get executed, but if you're at all prudent, you might want to stay away from market on close orders. And if you provide orders in this sort of environment, a good time of the day to put an order is when it's quiet. Historically, if that happens at all right now, but midday. Um, you think liquidity is lower. No, the market makers actually have time to babysit a trade, especially if it's a more significant trade. Anyway, monetary policy, I touched on the Fed. Um, One of the things that's happening here is that we're monetizing a lot of the things that were happening, and I'm going to bridge here monetary and fiscal policy a little bit. Um, the I tweeted a chart the other day of inflation in Germany. And when anybody hears inflation in Germany, they think of Weimar Republic. No, I'm not talking about Weimar Republic. I'm talking about German unification. German unification in the early 90s was expensive. As you may recall, we in Germany provided um, equal purchasing power to East Germany versus West Germany, whereas East Germans weren't as productive as measured by economic output. Um, and so what you did is you pretty much overpaid folks in East Germany as a political decision. Part of that then led to high unemployment down the road and lackluster growth. But what it in the short term led to is high inflation because you needed to pay for this somehow. So you had about 6% inflation at a brief period in Germany. Similarly, in order to, the fiscal stimuli we have are enormous. I mean, we just agreed in Congress on a 2 trillion package, at least the Senate has agreed on it. I presume it's going to pass in the House. And if not this version, a similar version. Germany today passed a 700 billion euro package. And keep in mind that Germany is 1/5 of the US economy, approximately in size. Switzerland the other day passed 30 billion Swiss francs, if I recall the number correctly, and that's probably not the last they're spending. So enormous, enormous amounts of money are being spent. They may well end up on the balance sheets of the central banks. And so we are monetizing that debt, which will ultimately get us the sort of inflation we've been looking for. Historically, one way to get out of a depression is through wartime. Well, we're quite lucky. We may not have a war, we just have a virus, right? But the idea that the ramp up in spending it is also going to be significant, and maybe it's not as much as in wartime, but these are rather astounding. And of course, one of the questions is, what is the money being spent on? By all means, perfection is not the goal in a crisis. Speed, especially in staying ahead of the virus, is more important than perfection. But if you think about the $1,200 or whatever the amount is going to be that's sent to households, politically, that's nice. And it's, of course, a relief for those who need it. But how far do $1,200 get you? Now, in the Bay Area, where I live, in California, not that far. Maybe in other parts of the country is further, but is it a week? Is it 4 weeks? In any case, a $1,000 check does not cure the virus. And it costs hundreds of billions, and we'll probably be spending over $1 trillion in direct payouts in the near future. Now, if you have $1 trillion, in my view, you should spend that on getting the country back up and running. And it's a real shame that this is getting politicized, the safety versus the opening of the economy. Of course, we have to open the economy. We have to find a way to get people back to work, not just because human beings are social animals, but just for mere survival. The question is, of course, how do you do it in a safe way? And I was actually encouraged by the White House briefing the other day. We may all shake our heads sometimes about the peculiar way that President Trump is expressing himself, but the message was that as we try to reopen the economy, we need to have localized solutions. And I think that's a consistent message we're hearing if one kind of gets rid of the politics that comes with that. And of course, that makes that the only thing that makes sense, right? You need to find a way. And of course, in order for that to happen, you need to do all kinds of things. You need to ramp up the testing. You need to ramp up the health system capacity. And importantly, one needs to start educating people about the sort of conduct and behavior that comes after the shelter in place period. I'm sheltering in place. Everybody in my office is working from home, has been for a while, even before the shelter in place policy has been in place. And that's fine. But and I'll talk about that more later, that provides enormous stress on many people. You have your kids running over your laps, you have the dogs barking, people are thrown out of their routine. There needs to be a vision that's provided for the period thereafter. And of course, you can just give the hopeful message, we'll all get back to normal. Well, the truth of the matter is, we're not going to go back to where we had been before. We will adapt, and there's going to be a path. But you have to enable that path. And by the way, going back to that $1 trillion, a lot of that, when we have to think about kind of how to support the overall infrastructure to make it happen. And just to talk about that a little bit on other terms, credit lines tend to be more effective than cash payments. Guarantees tend to be more effective. The question is, who should provide these guarantees? I don't think it's the role of the Fed to provide guarantees. It's the Treasury that should do that. It's a political decision. Got to be very careful if you put the Fed in charge in too many political arenas, because there is going to be a backlash, and you may well have an administration that's tempted to tell the Fed exactly whom to extend credit to. You don't want that to happen. You need to have these things broad-based. So there are all kinds of little things that we need to take care of. The relevant thing is, though, The central banks are throwing the kitchen sink at this. The Fed certainly does. Australia just engaged in its first rounds of QE, and so we have a lot of things that are happening here in that. And by the way, in the eurozone, before this crisis already, you had Lagarde talk about how the ECB might coerce banks to do lending to support the climate change initiative. So there you had a temptation already to move into some fiscal arena. Lagarde seems to be very willing to pull out the bazooka and get in front of this. And so let's keep in mind that we are well on the way of MMT in some ways. We may not call it that, but there is a lot that's going to happen here. And on that. So let me here briefly look at whether you have questions. I have several other things I want to talk to you about, but again, if you have questions, you can submit them at merkinvestments.com, and here we go, at merkinvestments.com/streaming, and you can submit a question. And I don't see any questions yet. I hope that feature works. So let me continue here a little bit and talk about some broader issues. So inflation. Obviously, right now we are in this deflationary pull down, and there's no concern about inflation. It's quite the opposite. But the policy response may well push that higher, and we'll finally, quote unquote, get what we've been bargaining for. Let me talk about, if I could read my own handwriting on my notes, that would always be good. Yes, so let me talk about, and here I'm digressing now a little bit from the market to talk about some broader issues, and feel free if I ramble too much to tune out, but if you're interested, stay tuned. So on the health side, as I indicated before, we operationally, by the way, as a business, we do fine. We know many that have emergency procedures in place, and so those things are working reasonably well. To me, it helps that I'm a techie at heart. I actually have a master's in computer science. Many of you guys don't know that, and have the curse of a small business that I have been able to take care of many things. So we are actually quite self-sufficient. So that's good. But the new dimension is the health dimension. We need to figure out how to go through this. And if I can just give my 2 cents on that, mental health is mental. That means not only is it influenced by the outside environment, but we can also influence our own mental health and that of our environment. Human beings love to have routines. So in this new environment, try to find a routine. Try to get away from work if you're lucky enough to have work. Many people are not used to working from home. Separate, if you can, the office space from the leisure space. Many people cannot do that. Try the best they can, though, but don't check your business messages every second and before you go to sleep. So little things one can do if one cannot do the bigger things. Go outside. In most places, we're allowed to go outside. Go for a walk. Go jogging. Do some form of exercise. Do some home project, whatever you've been putting off forever. Right? Those sort of things. Also, our stress level is reflected on the other ones next to you. Anybody who has kids knows that, but the same applies to adults. The same applies to pets. Your pets are going to be a nervous wreck if you're a nervous wreck. And so anything you can do to calm yourself will help calm the other people. I'm not telling you anything that you don't know here, but this is extremely important in my view to get through this period on the mental health side, and to make sure that we will get through this. Now, let me make a broader comment here on the virus and how we will get through this. The shelter-in-place policy is the absolutely right policy to impose on areas that are more broadly affected. We need this crude approach. Dr. Brick said that we need a crude approach and then a framed approach. Absolutely, that's absolutely the right choice. The in order to contain this, um, we need to find a way to live with the virus. We're not going to eradicate this virus. It's too far spread, it spreads too quickly. But what we can do is we can find a way to live with it, and we've got to find it fast. The $1 trillion we have to spend on developing a vaccine and providing incentives to private industry to find a vaccine. We need to provide the help. We need to be able to incentivize the private sector to help find solutions. And I have no doubt some of the biggest inventions ever will probably come out of this. And obviously, you do need the government to help coordinate that. And of course, governments could do a better job. But we are where we are in any locality or in any country. And so just complaining about the politics doesn't help. What we can do is we can take care of our own health, of that of our loved ones, and we can help the system as a whole. And so to all those younger people who still don't take this seriously, and many of the not so young people who don't take this seriously, for the sake of everybody, one needs to get with it. And so what that will mean is that, yes, right now we are sheltering in place. There are other policies for different regions. But of course, the question is what's going to come next? And I am actually quite excited that finally that discussion and debate has started. It's not going to be easy, right? We're going to have probably significant restrictions as we get out of the shelter-in-place policy, and some places haven't even had them. If you think you're in a remote place, a remote country, well, forget it. You are not shielded. My wife talked to her parents who live very remotely. Well, you should still not touch with your bare hands the fuel handle at the gas pump, especially not if you're in your high 70s. You should wear gloves doing that sort of thing, right? And if you're listening right now and you have your hands in your face, well, take it off your face. Those are the sort of things that are easy, but we are, of course, not used to many of these things. And so, and by the way, perfection is not needed in this process. There will not be perfection. We have to devise a system that can deal with the imperfection. Some people will congregate. There will be some jerks that will disobey the orders. And that's okay. The goal here is to break the exponential growth. And in doing that, we have a chance that we don't overwhelm the healthcare system. So let me briefly tell you an anecdote of my brother. My brother had fever for 5 days or so. He was able to get tested. He tested positive. So after 7, 8 days, get into his fever, tested positive. His only symptom was high fever. Because he had reasonably high fever for a week, they asked him to come to the hospital. There, they measured his blood oxygen level at 80%. That's way too low. It's very unhealthy. It puts you at significant risk of some coronary issues that are quite serious. It has to be above 90. Healthy people have it substantially in the high 90s usually. And so, and by the way, there is something you can measure with many consumer gadgets. They may not be all that accurate, but you can measure the blood oxygen level and know that this is serious. You need to go to the hospital. Well, he was lucky. He's based in Switzerland. There was capacity. Admitted him. That was last Friday. On Saturday, he said when he was getting up, he felt it in his lungs. On Sunday, he was in the ICU. On Monday as well. On Tuesday morning, he got released from the ICU, and he, at this stage, obviously he's not well yet, but he's no longer in the critical phase. And so he has been very fortunate in that sense that there is a capacity. The reason why the death rates vary so much in different places is because of the lack of access to proper health care. And so that's why you need to have this ramp up, and that's why you need to break kind of this exponential growth. And so then of course we have to see what the next phases are. I also, Dr. Briggs finally explained as to why they don't test many people. It doesn't express it that way. Dr. Briggs is you see her in the White House briefings. She's one of the coordinator of many of these things, and if you are under 50 and have no other conditions, odds are minimal that you're not going to survive this. And so they're reserving the few tests that are available to those that are in the risk groups. Of course, that doesn't mean that you can go about your life because you haven't tested positive if you have symptoms. And so it is just something to keep in mind that behind the rhetoric of many of these policies, there is a reason, and there is good sense that comes with it. So with that, today I hope and think that my live broadcast was working reasonably well. I did not see any questions submitted, so maybe I do have to make this even simpler next time. But please come to merkinvestments.com, submit a question if you want to. I'm showing here a little bit of disclosure again because my compliance would like me to. I cannot discuss any products in any of my social media, so please, please, please don't ask product questions. Come to our website if you have product questions. Be glad to answer general questions, glad to communicate. Give me feedback if I do continue with these things, what sort of things you like to hear. In the meantime, please stay safe out there and stay healthy, and all the best to everybody. Take care.